Welcome to Accounting 201 Financial Accounting at Kapi'olani Community College. In this quick video, we'll run through Chapter 10 dealing with liabilities. The first and most obvious types of liabilities you'll see on a company's balance sheet are current liabilities. There are several of them that are of interest to us. Notes payable are frequently exchanged between banks and businesses and typically are evidence of the business having borrowed some money from the bank. They usually bear interest, but they can be between private parties too. Salaries and wages payable typically crop up at the end of every accounting period when the accountant makes adjusting journal entries for them. And taxes payable can consist of several types for a corporation. Income taxes payable on the corporation's income, sales taxes payable on its revenues, and payroll taxes payable on its employees' payroll, as well as the employer's share of payroll taxes. Other kinds of current liabilities: unearned revenue, typically going to be earned within the next 1 year or less, so usually classified as a current liability. And a special little computation needs to be done for long-term liabilities or long-term debt to break out that portion of it that's going to be paid within the next year. We call that current maturities of long-term debt. So short-term notes payable happen when they're going to be repaid within 1 year from the balance sheet date, and they'll be classified as a current liability. Now, they can be issued in a variety of different forms. The one that most people are traditionally used to is a fully amortized note where a constant payment is made every month consisting of part interest and part principal. There's also this old school type which is called a lump sum straight or a term note. And in that situation, you receive cash or whatever assets you issued the note in order to get, and credit notes payable for the vendor or the lender's name. And if you were to pay the thing back within the same year where you borrowed the money, then you'd calculate your interest just like we did back in Chapter 8 for notes receivable for the account payable, for the note payable. And you do that by taking the interest, getting the interest by principal amount that's borrowed times interest rate times time. And you calculate how much is going to be paid back by looking at the principal amount that was borrowed and the interest that you've calculated up to the date of maturity or repayment. So if we had a 6-month note for $50,000 that had interest of 10% per year, then our interest for 6 months would be, instead of $5,000 for a whole year, would be $2,500 for 6 months. And the amount we'd have to pay back when the note matures, the maturity value, would be the $50,000 that we borrowed plus the interest on the $50,000 for the 6 months that we borrowed it for. So the cash amount, the sum of those two. Now if we come to the end of a year and that note is, the repayment date is sometime after the end of the year, then we will need to do some splitting. And so what that involves is picking up the interest that's due for the period of time up to the end of the first year where the bonds were issued. Pick that up as interest expense and interest payable through an interest accrual. And then when you pay the note back at next year, you will debit that interest payable and debit interest expense for the 3 months for the new year, and debit notes payable because you're paying it off, and finally credit cash for the sum of both of those things, or all three of those things. Some standard entries you should expect for sure on a test are recording employee payroll and employer's payroll taxes. When you record the employee payroll, essentially what you're looking at is salaries and wages gets debited for the gross payroll cost. Social Security and Medicare taxes get credited. Liability accounts get credited. The employee's withheld federal income taxes gets credited. The employee's withheld state income taxes, also payable, also gets credited. And then if there are any other withholdings that the employee decided they wanted to do, that's voluntary withholdings, those would get credited too. Finally, salaries and wages payable or cash for the net amount of the paycheck, basically. The employer share typically matches the FICA taxes, so there's Social Security and Medicare matching amounts, and then the employer also has to come up with or take care of the cost of possible federal unemployment benefits or state unemployment benefits for these employees. Last kind of liability we want to look at is long-term liability. This is notes payable that are issued long-term, super long-term, are typically known as bonds, and they are going to be due at least more than a year after the balance sheet date. And when you issue bonds, generally they're going to be more like 10, 15, 20 years. The face maturity value is going to be the same as we previously computed. However, we're going to look at just the bond as being the principal amount. Now, bonds have funny pricing. Regardless of what price you actually sell the bond at, the amount that's going to get paid back is what's known as the face value. That's usually $1,000 per bond. So issuing bonds, you debit cash, credit bonds payable, and for the same amount, selling price and the face value. And nothing happens to the bond payable account for 10 or 20 years until you actually pay the bond off. The bonds are always going to pay regular interest. That's the face value of the bond times the contract interest rate that's printed on the bond times 6/12 of a year for your 6 monthly payments. And debit would look like a debit to bond interest expense and a credit to cash for the amount of the interest if you're actually paying it. Now, if you come to the end of a year and you have a year-end accrual, then you're going to have to take the face value times the contract interest rate, and then some number of months less than 6 or less over 12 will give you how much your interest expense and payable is for that period that you're accruing. And between these two things, you'll see in the current liability section, bond interest payable, whereas the long-term liabilities are where you pick up the bonds payable because they're many years due date. And if you pay after a previous accrual, then you're going to need to pick up the interest payable that we previously accrued. And another interesting thing about bonds is they can be sold at a price that's not the same as their face amount. So typically bonds are priced at $1,000 per bond. So you want to buy 10 bonds, that's $10,000. But they can actually sell at a price that's different than $1,000. So if they sell at 97.5, that means 97.5% of their $1,000 face value, or $975. If on the other hand they sold at 102.5, that would mean 102.5% of the $1,000 they normally sell at, or $1,025. That would be called a premium, whereas the less than $1,000 would be called a discount. And all these things are doing is trying to adjust for the actual interest cost on the bonds, because the cost of interest is actually the less opposite of what happens to the bond prices. So you'll see that when a bond sells at a discount, that's because the total cost of borrowing for us is going to be more than how much we got and the interest payments. And why does it sell at a discount? Because we pay less interest than everybody else, so our bonds aren't as desirable as other people's. And you'll see the proceeds from the issuance are less than the face value. And the reason why that's happening is because we had a low contract interest rate, so we had to sell the bonds cheap in order to get people to buy them. Now, if you sell bonds at more than their face value, that's called a premium, and you will see that by looking at the total cost of borrowing, and that being less than the proceeds plus the interest rate. And the reason why this works is because we've received extra money and we sold at a premium, and that's going to help us earn back basically some of the interest costs that we expect to have. The reason why this could occur is because our bonds pay better interest than everyone else's. Okay, hope this helps. Enjoy.